This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and once again, we are with Kathleen Kramer, and we'll pick up where we left off last time, talking about the United States economy and the recovery and how real estate's doing.
Remember, we talk about government irrational exuberance, right? And they're not regulating the marketplace. Well, this time around, the banks and the rating agencies all decided that multifamily housing was the place to be. So you had some banks, notably Chase, in California market. Chase was doing one of those fog the mirror type loans on apartment buildings. And basically, if you just hit a certain debt ratio, you could borrow, 70% of the value of this apartment building in that C-class space. And so a lot of people came in and bought these apartment buildings at rates of return that didn't leave enough meat on the bone for a downturn. So I don't want to get too technical with cap rates and all this kind of jargon, but basically, if you think about it, most of these transactions on these apartment buildings are going out with only a profit margin of 3 to 5%, and 5% would be high. So right. That'd be a home run. Like, hey, I got this cap rate of 5%. That would be woohoo, party. But what it didn't take into account was a high enough vacancy factor. And what if your collections go down significantly, like we're going to see? And we're going to see how this experiment turns out here in the next 60 to 90 days. Because with the lack of subsidy, unless the Congress comes back and works out a miracle and they all of a sudden hold hands and sing Kumbaya in Washington, D.C. and come up with some return to this federal minimum income that they're doing, unless that happens, I think we're going to see it in the next 60 days or so, and we could probably just watch that multifamily council rent tracker would be a good indication to see how deep that might go.
Well, there's also a move to get out of apartments and get to a single family home, where people are living close together. They want to have some space. So the apartments definitely had its run, and part of its run was on the backs of all the foreclosures that occurred to 2008, 2009, etc., where you had people's credit ruined for the first time in their life and they could not get back in. So they were a renter for 7 or 8 years, and now that time is over.
And again, we're going to have a variety of outcomes. You have some apartment owners, mom and pops, that have owned these buildings for 20 or 30 years. Right? They got in investing early. They've owned the property, and they've owned it and managed it themselves mostly. And I think they're going to be okay as long as I think it's going to be the transactions that were done in the last 5 years that are in trouble, because This is where the valuations got crazy. The loan to values are high. And I was talking with an investor yesterday, and he's a single family home investor. He's got a nice portfolio of 7 properties. Some in different parts of the country. And he was asking me, he said, is this the time to get into maybe a joint venture of an apartment syndication? And I said, well, yes and no. I think you might want to wait for a little while until the dust settles with all of this subsidy. But then I think it might be a good time, because here's what happens when income goes down on an apartment loan. So think about the financing for a minute. And this is a different concept for people to grasp if you're used to getting a Fannie Mae 30-year fixed rate loan on your single family residence rental. Because if you get a single family residence rental, Fannie Mae 30-year fixed rate loan, and the tenant moves out, as long as you make that mortgage payment, you're fine. But that's not how it works in commercial lending. So it's a completely different way of managing that asset. The bank is really your partner on those transactions. And they're going to require that you submit your income statement and your rent roll and your financials for the building at least once a year, if not more often now, because they're going to be watching over these assets very closely. And these loans have covenants and clauses written into the loan agreements that would require that if your income goes down substantially, there could be a clause in your mortgage that requires that you bring additional capital in and pay that mortgage down to keep the income to debt ratio at a certain level. So
Wow.
this is what happened with a lot of syndications in 2008 and 2009. So apartment syndicators got excited. Rates had gone up, if you'll recall, at the very end of the cycle the last time. Rates were going up. So these syndicators went out, they bought these properties, they assumed the loans that had been existing. Most of the commercial loans on an apartment building are not 30-year fully amortized. They come due in 5, 7, or 10 years, and you have to roll them over and basically requalify for the money. So what is more likely to happen is that the distress will happen faster because in the apartment space, because the banks are going to have to be protecting their balance sheets. And if they have to go in and look at a lower income profile on a building, they could be calling in some of these covenants. This is the danger in the commercial real estate space. So you're already starting to see it happen. I was reading articles this morning about the hotel space and some of the retail spaces, especially in the big cities, that are already renegotiating their loan agreements with their lenders. But I think it's going to come in the apartment space, and it's just a matter of when.
Well, that will be some bad news, especially connected to rent control legislation and the tenants having inability to maybe pay as quickly or as much, that type of thing. So that might be the wrong asset class to be in 2020 for a little while, for sure.
I agree. It's also where the most opportunity may be in the real estate field for our listeners, for the people that are in our world who may want to still manage their own properties. I mean, you have to have nerves of steel to manage your own properties in California right now, because the rules change about once a week. And every time you turn around, they're putting another ballot initiative on for rent control and rent boards. And, if Prop 21 goes through, that could really decimate our rental and that legislation now, they're calling for single family owners to be affected if you have more than 2 properties. So that could be a significant game changer for the single family rental market in California.
When I was, I looked at charts. I've looked at charts for the last 30 years pretty diligently, and sometimes you look at a chart and you think you've looked at it and got it completely, all the information it's going to give to you. And then I was looking at population gain, and I don't know why, but it just occurred to me, California has a lot of population gain, but I didn't pay attention to what it was made up of. And I did that last year for the first time. And virtually 100% of population gain in California right now, and probably going forward for the next decade or so, is births over deaths. It's not having anything to do with people coming here over people leaving. So California, it's interesting to me about, thinking about demand for real estate. It's basically got all the adults that are going to be here. I mean, it's sort of as many adults as going to be here are here already in California. We know there's people leaving and people coming, but people leaving now are outnumbering the people coming in. I don't know. Do you know the diversity of their income? Do people with less income leave and more income show up because of migrating from other countries?
I haven't dug into those statistics, so no. Okay. I don't know what that makeup is. No.
Okay. Well, what was interesting was the makeup of population gain. So I just moved to Florida. Almost 95% of Florida's population gain is migrating adults and families. Their birth over death rate is almost identical in number. So all of Florida's population gain is an adult family or an adult that moves in ready to rent or buy something. That's a very different population game.
Yeah, I guess I haven't looked at that because in our world of buying second trust deeds, we don't buy anything in California. Isn't that funny? We live in California, but we don't buy notes in California because we have found that they are there's still a psychological belief that they're worth more. And so it's our belief that the investors that are buying the California notes are overpaying. So we tend to stick with where we can get the deepest discounts, and that seems to work better for our business model. And so we've made bids on California stuff, but we don't end up getting them because we're just not willing to overbid. So I think the old saying, it's what you pay for something that really gives you that run on your investment. And don't get lulled in or swept up in the herd and overpay for an asset. Even if you think that asset is going to be strong in the long run, better to make your money on the way in is kind of the way that I've, over the years that we've, started to do that's how we do our investing now.
It sounds like more of the same reason that Bruce and the Norris Group are in Florida.
I completely agree. And I don't see any issue with you guys going to Florida. I think it's a very savvy move. It's kind of sad. I think that we would be moving our business out too if it weren't for our adult parents that we're taking care of and being with while we have the time to be with them. Rather than uproot the entire multi-generational family and all try to move to one place, we've made a business decision and a family decision to stay in California as residents until until the parents, have moved on. So at any rate, I can make arguments for going out of California. I still think there's money to be made in California in real estate investing. There's money to be made in any market. It's just how much can you pay for that asset? And then are you willing to learn and play the rules of the game that the government is going to set up?
It helps to know what those rules are.
Yeah.
That's
they
the
keep
biggest
changing every 5 minutes. Yeah, exactly.
Yeah, that's the biggest disadvantage for me is that I like to know the rules of engagement. Give me the rules. Let me understand the rules completely if I decide to play or not. But when I am in midstream ownership and I find out that you have the ability to change the rules that I thought had to get voted on, those are the things that bother me. Aaron sent me an article about taxing wealth. It never dawned on me that could be a state function. I thought that would be a federal function. And so now the state of California has come up with and I don't know, how does that get passed? Vote on that? I doubt it.
Right.
So that's a scary thing. So does that get proclamated into existence? Because some of these things will have pretty good ramifications when you think about, I would say less than 3% of the households pay 50% of the state tax in dollars. And so you're going to raise taxes on the small group of people that pay an awful lot of dollars, even if it's not a high percentage. That just seems to be a bad theory to end up with net less dollars and more problems to me.
Absolutely. And you don't have to have an economics degree to understand how that works. People vote with their feet. And I think we're seeing it in New York. We're definitely seeing it in San Francisco. People are moving out of the city and the vacancy rates are skyrocketing on apartments, but across all the levels, high net worth individuals, Elon Musk, taking his business out of California like he threatened to do, and he's making good on his promise down, and he's going to Texas. So, it's interesting to me, and we're really kind of in a wait and see profile right now to see what happens with the general election. But I don't see there's much hope for California in the short term, because what the problem that we have is we have this supermajority of one party in our state legislature, and they have the governor's office, the attorney general, and they're all on the same page, moving in the same direction. which is a direction that we don't necessarily agree with as real estate investors. And that's the issue. If you are on the welfare roll, you're loving it right now because it's getting easier for you, right? So it just depends on where you sit. I think it's going to be very telling, and you wonder when it reaches that peak climax, right? That point of recognition, the 100th monkey, so to speak, if you know that analogy, where the conventional knowledge in the population, the awareness gets to the point that, oh my gosh, we're going the wrong way. I don't know. That's a good question.
I don't know. It's a great question, not just on the state level, but the national level too.
That's right. That's right.
Yeah.
So
on the wealth tax, do you know how that gets implemented? If it ever did, is that a vote of the people, or is that a vote of people that are in government power?
Well, I would hope that they would take it to the people. I think that if they wanted to change policy, they would have to have something go through the legislature. The governor can't just change the tax code in California on its own. So I would think that the California taxes, is that what you're talking about, or are you talking about at the federal level?
No, in California, because I got the feeling that since you have sort of an emergency power, it's kind of amazing what you can come up with and say, oh, we can do that.
Well, yeah, I don't think it's that surprising. I mean, I understand what you're saying, and it is shocking to see what they will do on their own. They have the supermajority, so it's pretty much the only thing that's keeping them from going to full, complete rent control, full, complete, socialist type of agenda is the lobbies. We have the California Association of Realtors, we have apartment owners, we have other pro-business type lobbies that, do still contribute to campaigns and so on and so forth. And, every once in a while they can stop some of this madness. But the amount of legislation that is coming out and the types of rights that they're taking away, they're just pushing stuff through and hoping that it sticks. So to me, it's crazy, and I think it has to come to some kind of a crescendo. I think they probably could go a lot longer than we hope they can. But, they are collecting 2 million signatures to recall Gavin Newsom. So that there is a groundswell. It's starting to come from the grassroots of people acknowledging that, hey, you know what, the pendulum has swung too far. We need some more reasonable reactions. And I wonder if the school issue isn't going to help push that change of sentiment along, because it's pretty well known that the California teachers unions are the ones that are keeping us from opening our schools again, in the fall. And okay. I just don't think that people with school-age children, even if they vote Democrat, I don't think they appreciate that. I don't think they like the fact that the teachers union put all kinds of recommendations into their plan for reopening, such as socialized medicine, single payer medicine for all in California. That was in their recommendations to come back and reopen. That was a condition that they were suggesting for reopening the schools. The list was very, very long. And so, in fact, I try to stay out of social media political arguments. I got baited and I responded to a post about that issue, and, oh my goodness. So I hesitate to bring it up. Because a lot of teachers are investors, but it's not really the teachers. It's the unions that are the issue. So I don't know. I don't know that I have the answers to that. And I think that in California that even the statistics, so we're data people, right? You and I are data people, but even the data is unreliable.
Well, that's the thing. When you lose trust in the system, you have to rethink a lot of things, and it's troubling. I remember goes back to 2008, just watching Squawk Box in the morning, that they were going to vote on the TARP fund bill, the $700 billion. And Warren Buffett was being interviewed, and he said this. He said, to be honest with you, if they don't pass it, you need to go to your room and pray. Mm-hmm. And that scared the heck out of me. So I went to a bank to get, like a year's worth of money. Well, outside the bank, there was a line that was 40 people long, not with masks on, with IOUs in their hand, because at the time you couldn't get cash.
Right.
You had to order your cash. And that's the kind of stuff that, this year you thought, okay, I've got most of my ducks in a row and all that. And then you realize, wow, you can have a virus turn the numbers into a Great Depression. And then you realize there's a lot of people that are months away from big problems in their life, months away from going through all their savings and, being evicted or being, foreclosed on. I don't know what percentage those people are, but it's a lot more. And I think that's also makes you nervous.
Kathleen, I'm fixated on something you said. And you said earlier that you don't think it's going to be a V-shaped recovery. Do you have an opinion on what kind of recovery it's going to be, how long it's going to take, or is it more of if A happens, then this, or if B happens, then this?
Yeah, I think that I don't know that we're necessarily going to be able to know in advance what shape the recovery is going to look like. I think there's just too much that we don't know. And in my last talk, I really tried to break my talk up into a little differently than I normally do. And I broke it up into what we know, what we think we know, which was kind of the employment situation, and then what we don't know. And the list, believe me, for what we don't know is a lot longer than the list of what we do know right now. From my perspective, I think that a smart investor, if you understand your market and it's local enough and you understand the rules of engagement, as Bruce mentions, then, keep going, doing what you're doing. You don't need to completely go into a fetal position. However, if you're new to investing, you might want to sit and watch for a while and build your cash reserve, do some small short-term stuff if it makes sense. But I would really wait for a lot of this government intervention to settle down, at least past the election. And then depending on who's in charge after the election, then, try to make a few more assessments after that time. I don't think we're going to see a huge single family crash. We just don't have the excess inventory. People have equity. Even if credit gets tighter, I still think there's going to be people that can qualify and buy these homes from us. So I don't think we're going to have huge distress there. I do think there's going to be more opportunity in the apartment, repurposing the commercial property like the hotels, redevelopment of hotels into different uses.
Malls?
There's going to be a clearing, maybe some of these smaller hotels need to be senior housing. I don't know what it's going to look like, but I think that what we could do is we can figure out what are the things that we're looking for.
Well, that's one of the things that you said, right? You end it with a long list of events to watch. So my question for that was, what's the most important event to watch that's going to impact real estate?
I think right now the most important thing to watch is if the Congress can put together an extension, a meaningful extension of the federal unemployment subsidy. That's propping up the apartment industry right now. And if that shoe drops and we have a huge vacancy or a non-payment collections issue in the apartment segment, I think that could trigger the banks to tighten their credit across all the platforms, because they're already setting aside a lot of money for defaults in the commercial space. I know Wells Fargo just put aside $6 billion, Chase put aside $4 billion out of their profits in anticipation of these losses coming through. And the Fed is buying the bonds. They're supporting the interest rate market, but they're not going to do that forever. At some point, they're going to allow that market to clear, and the true cost of credit is going to change the pricing model of these assets. So I think what we're looking for is how is the government going to phase out this extraordinary subsidy that they've been providing? How fast can these jobs really come back? And I just don't think we know. To give you an analogy, I used a roller coaster as my graphic instead of a V-shaped recovery. I think it's
it wasn't a typical roller coaster either. It had so many turns.
Roller coaster. And your experience on a roller coaster, it changes depending on where you're sitting, right? If you're in the front seat on a roller coaster, that's the most adrenaline. That's the riskiest spot, if you will, because if it's going to go off the track, you're going to be the first to go, right? So these are our medical professionals who are on the front lines. These are people who perhaps contracted the disease. These are people that are holding huge hotel REITs. These are, the airlines. These are some of the people that are kind of on the front line of the risk, if you will. There's a huge list of them. I'm just giving you a sample. Then you have some of the people that are kind of in the middle, and then some of the people that are in the back. And when you're in the back of the roller coaster, you see what's coming ahead of you, right? You can see maybe people are sitting, they have a nice portfolio, has a lot of equity, providing a lot of cash flow. They have high quality tenants, and they're just going to sit and watch and ride the ride. I think that the experience that people have will be very different depending on where you are in your life and where you are in the risk profile. I just continue to look at the data, try to make good, educated decisions, and then take action. That's what investing is all about. There's always risk. It's uncovering as much as you possibly can, and then making choices, and then living with those choices. Sometimes they're good, and sometimes they're bad. But we always learn something from those choices. I know we're probably close to wrapping things up, so I just want to say that I am working on a new project. I'm coming off of my sabbatical, and I'm working on a new project. We're not really ready to launch it yet, but I have a partner. Most of the people on this call probably know who the person is when they find out. And we're going to be trying to convey to real estate investors the benefit of some of these lessons learned from some of our most seasoned investors, and then help people try to walk their way through these uncertainties and keep their portfolio strong. So there's enough of a hint, but I'm excited about it, and it puts together all the different experiences I've had over 30 years almost in the industry. I've made a lot of mistakes, so we could talk more about those on another call. and because that's what we learn from, right? And so I want to hear people's stories about the wins and the losses, but more about what they've learned through those losses, and so that we can try to help other investors find liberty in their life. Because I think real estate is still one of the best ways that people from all walks of life can change their situation. They can pull themselves up out of whatever situation they're in and make something bigger and better out of their life through real estate. I really honestly believe it's one of the last vehicles available to folks. And it's very approachable. Anybody can do it. It's just a matter of getting through that first fear that you have and taking action.
Kathleen, I completely agree, and I do suppose we're out of time. So thank you so much for joining us. Your website, can you give that, please?
Oh, yeah, sorry. I forget to give myself a plug, don't I? So if you want to reach me, it's libertyre.net, libertyre.net. And you could email me at Kathleen, Kathleen, at libertyre.net. And you can also connect with me on LinkedIn at Kathleen M. Kramer. I love connecting with folks on LinkedIn, and that's really the platform that I like to use for my social media stuff. So if you're curious about what we're going to be doing in the future and want to engage, that would be a good thing, is just friend me or connect with me on LinkedIn, and then you'll be in the know when the announcement happens. And good luck to you out there, Bruce. We're all rooting for you. And you may have a few thousand friends following you to Florida.
Yeah, well, I'm already up to my eyeballs. It was funny yesterday, and then we'll have to wrap up. Yesterday, I was driving the area where we have maybe 20 houses being spec'd, and you cannot look down a street without seeing a construction toilet. There was no street that I could look down. There wasn't activity. It was such a startling difference.
Maybe instead of a laundromat, we should be starting a porta potty rental company.
That would be big in Florida for sure.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.